couple of things to focus on based on what I've been asked by clients and other advisors, interestingly, this week. Firstly, the horrible subject of world events. Now, it does feel very wrong to worry about the effect that what's happening in Israel and Gaza might have on investments. But even this morning, I had a text to the effect that the world is going to hell in a handcart, so should we cash everything in just in case? In case, I guess, things get far worse and spread and lead to, well, who knows what. The answer, perhaps sadly, is that even the very worst happenings do look like only blips in the long-term graph of share and bond growth and returns. A chart shared by one of our principal fund managers goes right back to Pearl Harbor. The American stock market fell by nearly 20%, stayed low for 6 months or so, but took less than a year to recover. And of 25 events like this, not as bad, right up until last week's atrocities, the average fall was 5%, and the recovery time just 6 to 8 weeks. It's actually interest rates and inflation which are far bigger worries for the great world of commerce at the moment. And the recovery we're starting to see, which has led to positive returns over a year now for most of the portfolios we recommend. Sorry, I slipped into fund manager speak there. I mean, you can now see that over 1 year, they've all gone up. Even, and perhaps especially, the income portfolios, which were hit hardest by Trussonomics last year. And a client I saw this week was very pleased that she's now slightly up over a year, even after having had an income of 3 or 4% from her investments. Because I'm often asked not just whether when things look grim, we should move to cash rather than leave money invested in stocks and shares, but also whether we, as advisors, should be suggesting that you move out of funds and portfolios which haven't gone up in the last year or so. The answer to both is, as you'd expect, no. And to the latter, because we actually measure the performance of the managers and investments we recommend against other similar portfolios of the same level of risk. If they are pretty consistently doing better, then I'd still say it's best advice to leave them be. And I can confirm they are.